All right, I think we are live. Hello, everyone, and welcome to this week's edition of the Dividend Power Hour. If you're a returning member or returning viewer, welcome back. If you are brand new and this is your first time watching the Dividend Power Hour, this is our weekly live show where I give you my thoughts on the market overall, maybe some stocks that I'm looking at, review some of what's been going on in the market, and then take some of your guys' questions as well. So welcome. It's great to be with you each and every week. Again, if this is your first time viewing, my name is Mark Rusin. I am a CPA here in Southern California. So again, if you're a first time viewer, welcome to the show. Let's see, where are we tuning in from today? Let's see the broad range of folks that we have. I already see a bunch of you in the comment section. Again, this is meant to be an interactive show here. So if you have questions or you have comments, a lot of those questions could probably even be answered by many of the returning viewers within here because we have a lot of great folks that we see each and every week, but it's always great to have new folks there. H-Town, Texas. Good to see you, Michael. We got Singapore in the house with Sean. Awesome. John Bircher is in the house. Good to see you, John. Hope all is well. Boston suburbs, I should say, is in the house there. We got Michigan with Gretch. Gretch, welcome back. Good to see you. Fort Worth, Texas. Shiva, good to see you. Tim, returning member there. Hello from the poorhouse. Honeybee is from Georgia. Jeff Hansen from Minneapolis. We got Ron. Ron's tuning in from Birmingham, or Birminghampton, I should say, not Birmingham. Chicago, Illinois. Jeffrey Hatch tuning in from sunny Washington. It feels like a spring day here today in Southern California. For those of you that are out, I know there's a few of you that don't live too far from where I'm at here, and it's about an low 80 degree day here in Southern California. So it finally feels like spring again. So it has been a nice day. Jordan's got some heat though. Jordan's got 90 degrees there in Vegas. All right, Rob is in the house from Michigan. Hi, Mark, a true Texan here. Nice. St. Louis is in the house. Another Vegas. Good to see you, James. Dennis is a jet setter, is tending to my horses in, I don't even know how to say that this morning, and now back in New York City, but no matter where I am, always catch the Dividend Power Hour. Love it, and I truly appreciate that. There's some SoCal love right there. And then Honduras is in the house. Awesome. Well, thank you guys so much for tuning in. Let me know, did you guys buy anything this week in the market? We have gotten a dip. This is that dip that we've been kind of talking about here for a few weeks now of a pullback. Valuations look stretched. Market doesn't look all that great. Overall, economy, is it slowing down? Is inflation still an issue? A much needed, much foreseen pullback, although it didn't happen as soon as we thought it would. But we have a lot of things we have some geopolitical concerns. We have high inflation. Is the Fed switching gears? A lot going on. Valuations up. Oh, and by the way, we're entering earnings season. Oh, and on top of that, let's just throw in a presidential election. Why not? And this one's not supposed to be that heated or anything like that. So I'm sure it'll be really calm. No, not really at all. So let me know. Have you taken this opportunity to make some additions, or are you actually entering into all this selling that's been going on? Are you selling some of your positions? Let me know in the comment section. Are you buying anything? Are you selling anything? What's going on there? Scott's tuning in from New York, upstate New York, and New Jersey's in the house here. JC, good to see you as always. Is this a good dip to add some more good stocks or wait for more? We're definitely gonna have to talk about that today and in tomorrow's free webinar, which we're going to talk about. So you'll see a link down there. And we're going to talk about a little bit more as the show progresses here, but I'm hosting a free kind of this emergency update with everything that's happening in the market right now. Is this a big dip? Is this a dip that's going to get bigger? Should we wait for our pullbacks and to buy, or should we start adding right now? We'll be talking about all of that in tomorrow's free webinar. We're going to talk about a second, but if you want to jump ahead and you don't have time to wait, there's a link down below where you can save your spot. They're completely free with that webinar there. James bought some USB and some Vici, so REITs got hit really hard, rightfully so. There, John Bircher bought some triple Qs, SCHD. SCHDs had a nice little pullback there just in like the last 5 days or so as well. Some HDV, that's a solid higher yield focusing dividend ETF, and Starbucks. Starbucks looks like a great valuation. I know, John, you and I spoke about that in that options play that I had recently. Looking to buy some Starbucks under $80. So I have a cash secured put sitting right at 80. If it dips below there, that's where we'll be buying it. Bought some United Health and CLH. There we go. We got our United Health bounce. So we've seen those big dips from United Health lately. And most of the gains that we saw in recent days from the Dow Jones is related single-handedly and more to the United Health bounce that we saw when they posted earnings just the other day there. What else are we buying here? So we bought some Snowflake, some JEPQ, and DGRO. So we're kind of layering into some ETFs there. I think we have not hit bottom yet, holding off on adding. Not a bad idea there, Tim. There's a lot of there's a lot of reasons to see a small upside bounce here, just given the selling pressure that we have seen. But there's a lot of down. We've ran so far. Things are, what I talked about early on. We have elevated valuations from stocks. We're entering earnings season, so it's going to add even more volatility, geopolitical concerns, all of this stuff that's kind of hitting against the markets all at the same time here. Kenny bought some HD, some Visa, some SPY, and some SCHG. Oh, some more Texas. I think Texas is holding it down today so far in the Dividend Power Hour. What do we hear? We got some selling here from Kevin. Sold off some 40K funds that weren't performing, hoping the money transfers so I can buy into this dip. Chris bought some Vici. Jordan's got a rookie question. Will I be charged having high yield stocks in my Roth IRA like Vici, Maine, OBDC? In terms of what you mean by being charged, if you're asking, will I be taxed for the dividends you get if it's sitting in a Roth IRA? The answer to that is no. So if that's the question that you have, will I be charged? That's going to be the answer there overall. If it's something different, just let me know. Rich Diaz, good to see you. Bought some VOO, some DGRO, SCHD, and some Visa. All right, Jeffrey, what do we got? UNH on a nice dip. Wish I could have bought more. No problem. Just keep nibbling away there. There's plenty of opportunities along the way. I'm in for tomorrow. Looking forward to what you have to say. Awesome, Scott. It'll be great to have you. I'm looking forward to that free investing webinar. Again, free investing webinar tomorrow. It's kind of this emergency update. We've got a lot of questions in the past week about this dip and how do we play it, as all of us, most of the time here, are looking to manage our own portfolio. So how do we approach it here in Q2 and things like that? We'll touch just a little bit on that surface layer there in terms of some approaches, but we're really going to dive a lot deeper tomorrow. Also take a look at my top positions that I have in my portfolio, some top watch lists and all that stuff there. So JC bought some XLE. Energy's been the play lately, and we've talked about it a lot on this Dividend Power Hour here. Hello from Texas. Another Texan here. Man, Texas is hot in the Dividend Power Hour right now. Thanks for everything you put out. It's been very helpful. I'm new to investing, so I need all the info I can get. Well, it's great to have you, Christina. Welcome to the Dividend Power Hour. All right, Henry, waiting for a larger dip on Microsoft and Visa, two high-quality companies right there. I like both of those companies. All right, I've decided to buy more growth than sell and reinvest into those dividends. No problem there. This is when you're managing your portfolio, especially if you're a long-term investor, you're not going to remember that, hey, I bought at a 5% dip or I bought at an 8% dip. The idea is to look at valuation to see which ones make sense. Even though we get a dip in some stocks, they still could be expensive, where others look like a deal. That's why it's so important, especially when you're managing your own portfolio, is to understand how to evaluate and look at valuations for particular stocks. This is exactly what we do within our 6-week investing accelerator course. There's already a number of you that have taken that 6-week program where we've gone through all of the different metrics that I look at. You never want to look at just one metric. 90+% of investors out there look at what's called the PE ratio and they stop there. A very flawed way to look at specific stocks. I'll show you that, the PE ratio, in a lot of my YouTube videos, but I stop there. And within the 6-week course, I go even deeper because it's not something I can do in a 9-minute YouTube video, an 8-minute YouTube video and stuff like that. So if you're interested, definitely schedule a call, a free evaluation to understand more about the program. And I'll give you a little insight. If you join tomorrow's free webinar, there may be a little sale going on. So I'll just leave it at that. All right, Josh, what do we got? We bought some NEE, solid, some N and OZK for Josh. Just finished up my MPW for covered calls, my first position there. Awesome. Well, I already love how interactive today's group is. We're already almost up to 100 people there. And again, if you haven't done so, make sure you smash that like button down below. It's true. I truly appreciate it, and it really helps the growth of this channel. So with that, let's jump into our Dividend Power Hour slides right now. So if you've joined us before, this is our economic update right here. So this probably looks very familiar to you. We're going to first take a look at the market updates. So the Dow Jones year to date squeaking out a slight gain. And really, who does it have to thank for that? Pretty much entirely United Health over the past week. Previously, though, year to date, they were up 1.8%. So we've had a little bit of a nice little pullback there in the Dow Jones, irregardless of what UNH was able to do. S&P 500's up about 5.5%. That's down from the 8.2% it was up last week. NASDAQ's at 4.7. That's down considerably from the 7.5% it was up last week. And then the Russell has dipped back into red territory. So it is down 2.2%. It was barely squeaking out a gain of just 0.4% the last week when we had our Dividend Power Hour, but that is firmly down into the 2.2%. And we'll talk a little bit more about that here in a second on why. In terms of valuation, looking at the S&P 500, currently trading at a PE multiple of 20.1 times. Where does that compare to historical averages? Well, over the past 10 years, the S&P 500 typically trades a little bit closer to 17.6 times. So that's something you want to take in mind. Is we've been trading in these elevated levels. But if you've been along on this ride here over the past few months in the Dividend Power Hour, we started seeing that S&P 500 PE multiple up at 23 times. And it's slowly starting to come down. Remember, there's two parts when it comes to a PE multiple. There's the price and there's the earnings. We are launching into earnings season right now. So there's going to be a lot of adjustments as to where that PE multiple is heading forward. All right, interest rates have played a big role here. We've got an initial dip over the past week or so, but then in just the past few days, we've seen a surge higher when it comes to interest rates, and we'll be taking a closer look at those here in a second. But let's talk about some of the top stories that we're going to discuss here in a little bit more detail as this Dividend Power goes on. Dividend Power Hour goes on. We have the Fed doing a 180. We have a Fed pivot now where it was initially we were kind of talking about, yeah, we're going to have at least 3 rate cuts. Things are setting up. Conditions are setting up. Rate cuts are likely here in 2024 to where, well, the conditions aren't just where we want them to be. Inflation isn't coming down as fast. We're not seeing the improvement. There's no weakness out there that's going to indicate that inflation is going to come down that much. Job market is still fine. Average hourly wages are still increasing. All things that can lead. So you can't just cut rates or we're going to be surging inflation again. So a lot of you, we've gone through this questionnaire. We're going to do it again today to see if any of you have changed your mind here, where there was a few of you, not a lot, but a few of you that said, hey, we're not going to have any rate cuts here in 2024. And those of you that have said that in recent weeks, you're looking pretty darn right, because that is the direction we're moving. Based on the latest data that we've seen, there's no indication that the Fed should, in fact, cut rates right now. Why do they need to cut rates? Well, if inflation's coming down, then they have the reason to do it because they don't want to keep rates higher. They don't want to keep rates elevated, which could potentially impact the economy. If their work is being done and inflation, in fact, is coming down, then that's what they're out to do. They're not out to just impact and decrease growth. If they can do it in a way to where they keep growth, moderately high, not exploding, but moderately high, people not losing their jobs and inflation starting to decrease, people not spending money essentially, then they'll start to cut rates. But until then, there's no reason to, because we can get back into the same situation we were in just about a year and a half ago, 2 years, when we saw inflation growth of 9% and then 8%. And we're at 5%. We're still, right on the cusp of 4% growth comparing to those historical averages already. We're 30% plus higher on energy, food prices. And those are just a couple of sectors there. So no cuts here in the near term at all there. Fear levels are up. High inflation, no Fed cuts coming. We have seen just a few Dividend Power Hours ago, I'm going to say no more than 2. We were on the cusp of looking at the Fear and Greed Index. We were on the cusp of looking at extreme greed and greed. Lo and behold, just 10 trading days later, here we are firmly in the fear level. Investors are concerned about where things are at. Investors are concerned about what's happening overseas. Investors are concerned with inflation, the Fed pivoting. A lot of investors, remember that when we invest, we're looking forward. We want to know what has companies done for us in years past or in quarters past. When they report their earnings, great. Revenues are trending in the right direction. But more importantly, we want to know what can we expect moving forward? Because that's how most of valuations, when investors invest, when hedge fund managers invest, what are you expected to do for me moving forward? And moving forward, we had expected easing monetary policy. That doesn't appear to be the case anymore. So how we evaluate the stocks, we can't price that in anymore. We need to price in higher interest rates for longer. we've talked about it on this show that we do expect interest rates higher for longer, but we've also been expecting at least 2 rate cuts, maybe 3. Not so sure that's the case anymore. And we're going to take a quick look at those here right now. So let's first take a look and see where bonds are. So let me bring in the old iPad here so we can take a closer look at where things are sitting at. So here we can see that's the Dow Jones. You can see the NASDAQ and all of that stuff that's going on. But I want to go down here to the market's diary section where we can see the number of stocks advancing. You can see the number of stocks that are at new highs, but you can also see the number of stocks that are at new lows. And that is something that I look at every so often, once in a while, but it's starting to increase when you've looked at it lately. So obviously we've come down about 5% or so from the highs that we saw just a few weeks back. But now when you look at the NASDAQ, today alone, you had companies hitting brand new lows of 243 companies. Over in the New York Stock Exchange, about 62 there. So this is something that updates on a daily basis. You could see the number of stocks advancing, that means increasing, and you could see the number of stocks that are decreasing overall there. So that's the market diary section. You could see that on the Wall Street Journal there. Just something I look at every once in a while, especially when things start to get a little more tight. Now let's take a look at bonds. We talked about how bonds had dipped initially and then jumped back up. So let's start with the 10-year note here. And let's look at on a year-to-date basis. Let's go back here. Year-to-date. And look at this. We saw an initial dip. I mean, it's slowly been slowly but surely increasing. Again, this is the 10-year note. So we started off pretty low down here below 4% to start the year. This is a year-to-date chart. We increased a little bit, but then we saw the dip. We were like, okay, rates are going to start retreating. This is when folks were like, hey, we're going to start seeing rate cuts here maybe in the spring, the latest in the summer. Doesn't appear to be as much of the case anymore. But as you look further, now we're starting to see a steep increase back towards that 4.75% interest rate on the 10-year. More importantly, when you look at the 2-year note, it's going to be a lot of the same there in terms of our year-to-date chart. Let's look at year-to-date here. We are headed back towards that brutal 5% range, something that we thought we were kind of past from that standpoint. Again, we touched about 4.99% in recent days there. We've retreated just slightly. However, that is something to be concerned about because borrowing costs, we thought those were going to start coming down. However, that's just certainly not the case right now. And interest rates are back on the move, moving a lot higher than we expected because, again, what was the wording that came out in terms of the Fed the other day was a reversal. And Fed Powell says inflation data, it's a lack of progress. We're not seeing the progress that the Federal Reserve had expected to see. And that was their reasoning for wanting to cut rates there. So, well, that one's not going to work. So we're just not going to look at that particular one there. But we'll just look at it here without drawing. So again, the Fed is trying to get to a 2% interest rate. A 2% interest rate is what they want. We're sitting right around a 4% interest rate as it stands right now. So not all that close at all. And things are not progressing at the speed the Federal Reserve had hoped it would do. And the verbiage, so many people in the past, call it 3 years, 2 years, 2.5 years, have been so fixated on every single verb, every single word that Fed official Jerome Powell says that it can simply move the market. If he just uses one different word than he had used in the past, boom, the market can jump, or boom, the market can tank. And it's pretty wild from that standpoint there. So again, this was the fastest, we've seen the interest rate hikes they did it 11 times over the span of the past 16 months. From 0 to 5%, it was the fastest since the 1980s there. So, we've gone higher and it's starting to play a role. They're hoping it's going to start playing even more of a role here moving forward. But it seems like based on the next Fed meetings that are coming along, don't expect anything in terms of rate hikes or rate cuts there. So let's take a look at the CME FedWatch, which this is going to look at the possibilities of rate cuts. When do we expect rate cuts here moving forward based on the Fed futures? So that's what this is exactly looking at here. So right now we're at this range of 5.25 to 5.5. That's our interest rate where it stands right now. Think of it as a borrowing cost. That's where it is. As these are higher, it takes a lot more to borrow money for companies to grow, especially smaller companies from that standpoint there. When interest rates come down, that increases borrowing. It's cheaper now for companies, and that can spark some GDP growth, some economic activity. Companies starting to borrow more because it's no longer 5.5. It's now down to 3.5, or whatever the interest rate is from that standpoint right now. So right now we're at that 5.25. The next meetings are right here on the left side. And if you've seen the Dividend Power Hour before, this is nothing new to you. You've seen this schedule. So the next meeting is on May 1st. Not too far away. Just about, what is that? Less than 2 weeks or so away from the next meeting. 96% based on the Fed next 30 days in terms of future pricing, believe rates are going to stay exactly the same. Not until the now September rating yet. When we looked at this last week, I think we were implying about 3 interest rate cuts. But now when you look at it, 46% believe that we are going to go down just 25 basis points here moving forward, and it'll stay there from September through November. Not until, and it's only 35%, so it's not overwhelming, do we potentially get a second rate cut in mid-December there. So just 35% believe we will be at that 475, 500 level there. But still 31% thinks we're going to be. So really, what's being priced in for the remainder of the year now is only about 1 rate cut. And that has changed drastically just in the past 24, 48 hours since Jerome Powell came out and pivoted saying, hey, the data is just not making sense. Not that it doesn't make sense. It's just not doing what we expected it to do. It doesn't make sense in terms of what we see we should cut. That's not the case at all. What we see means we need to hold rates. In all honesty, what they should do, not what they will do, but what they probably want to do is they probably want to do one more hike just to put even more pressure. Let's crush this inflation right now and really slow the economy, slow inflation, and then bring down those rates rather quickly there. Will they do that? Probably not. But that's where we're looking at right now when it comes to probabilities. So a lot of you have been spot on for the ones that said we're not getting any rate cuts here in 2024. And I applaud you guys for that because you guys just nailed it overall. So great job there overall for those of you. So let's jump back in. So we've talked about the Fed pivoting. We've talked about fear levels increasing. How about housing? Housing looks out going forward based on what the economy does. Home builders don't want to build homes if they don't think they're going to sell because they don't want to sit on them. That's not a good thing for them if they're sitting there on homes that can't sell. So what is a forward-looking metric when it comes to housing? It's going to be building permits. It's going to be housing starts. This is the beginning stages, the beginning process of building a home. Think of just dirt. It's nothing more than dirt there. They got to go get permits and all of this regulation stuff before they can start building a home. When you look at the March data that just recently came out in terms of housing, you could see housing starts fell 14.7% in the March report. Building permits fell 4.3%. So it's not like one was going the other way and one was going, up. No, both of these together came down, not as much as the housing one came down. And in addition, Equifax came out with a report saying what has been weighing on their business? The lack of housing, the lack of mortgage demand. The home builders are all seeing that right now, saying, hey, we probably shouldn't be building right now because we see what's coming. It appears like if an economy slows, if the growth slows a little bit, we're going to be sitting on homes and we don't want to do that. Or mortgage rates are so high, we don't have buyers that can pay this. Because prices and costs aren't going down, they have to price these homes a lot higher just to make their money overall. So, question here from Shiva, can they increase rates? Absolutely. That would be a bummer, and it would impact the market in a huge way. And I think that's why they're not going to do it. Another reason is because it's the election year, and they don't want to spice things up and think, they're going for one side or going for the other. They try and stay out of the political world, if we can believe that or not. So let's keep rolling here. All right, so here's the latest look at our fear and greed index. Again, we were looking over here at the greed, extreme greed. We were right on the cusp of falling into extreme greed just 2 weeks ago. And now, lo and behold, confidence levels are out the door. Investors are selling. The Fed has pivoted. All of this stuff we've already talked about now, and we are firmly sitting in that fear level. And that's why a lot of folks have been reaching out to me saying, what do I do? Do I sell and buy at a lower cost? Is this the time to start dip buying? And that's exactly why we're having that emergency webinar tomorrow. And let me take the opportunity just to tell you guys about that right now. So it's an emergency market update. It's a free investing webinar. If you want to come, show up. We would love to have you. Save your seat. There's a link down below. Thursday, April 18th, 8 p.m. Eastern time, 5 p.m. if you're on the West Coast. What are we going to discuss? How do you approach this down market? Fear levels are high. What should I do with my money right now? What should I do in April? What should I do in Q2? What should I do for the remainder of the year? What am I seeing? What am I doing? Stuff like that is what's going to be discussed in this webinar. We're going to go through a Q1 recap. We're going to touch on my top positions, and not only my top positions, but what are some of my top watch list stocks? Which stocks are high on my watch list that I'm looking to buy right now if, in fact, we see those prices dip even further? That's why it's so important to always have a watch list report so that you're always ready for when we get these opportunities that come. And you want to do your homework early, do your due diligence early. You know, I'm obviously a big buy and hold investor, but there's no company out there that's just a buy and forever. It's a buy and monitor. If you're going to be buying individual stocks, you got to consistently monitor it. It may not be every quarter, but maybe every other quarter at least. Do an update of overall valuation. You should always have a list of reasons on why you invest in a particular company, X, Y, and Z. And you need to do the update to make sure that X, Y, and Z is still the reason that you wanted to invest. Is that company still making sense of why you invested in that particular company? So join me tomorrow, free webinar. And if you're unable, there's also a VIP option. We'll be doing some Q&A after as well. You can get the entire replay if you're unable to join. So you can check that out as well. So that's a free webinar tomorrow. Free investing webinar. You can see the link down in the description below, and I hope to see you guys there. John, if we signed up for the webinar, will it be recorded? It will for those that elect to do the VIP option. So for the Q&A session, you also get the access to that recording as well. So good question on that. Any other questions out there on the webinar? Matthew thinks some REITs are starting to look juicy. They've been looking juicy, and they looked even juicier today. But again, that's a sector that we talked about last week. Which sectors are going to do well when rates start to, in fact, get cut? It was REITs, but it doesn't sound like rates are going to get cut anytime soon here. So that's why I continue to call that the REIT sector that accumulation phase that we're in right now. It's not something that I say, hey, back the truck up to. No, I'm just nibbling here and there. Buy a little Agree Realty. Prologis down 6% today. Buy a little Prologis. High quality companies that, I'm just nibbling at here and there because we never know where the exact bottom is. Valuation looks great. I have no problem buying at this particular price. That's why it's always important to do our homework ahead of time there. So hope to see you guys at that free investing webinar tomorrow. So going back to high fear levels, what are some reasons to be fearful right now as an investor? There's a number of them. I only listed 4 here. We're going to go into a number of them in detail in tomorrow's free investing webinar. Well, we had a hot start to Q1 2024, that should say there. We had a hot start there to 2024. Valuations are high. They're stretched. That was coming out of 2023. Valuations are high. So if things don't hit perfectly, earnings don't hit perfectly, that's when markets get hit. That's when individual stocks in particular get hit. If you're priced for perfection and you don't beat earnings and give good guidance, you're probably going to get hit from that standpoint. We saw that we just talked about the change in the direction of the Fed. No more are they really thinking about cuts anytime soon. Will we in fact get one? Potentially. We started off with 6, which we knew that was just people were smoking fluff. I don't know what, but there was definitely not 6. I don't know why anyone ever thought there was 6, but if you looked at that CME tool that we look at every week, it showed 6 rate cuts. And if you've been a follower of this show, you know that we were never in that camp. We've been in the 2 to 3 camp right now. And now we're probably leaning more towards the 1 to 2 camp there. So in addition, we have geopolitical concerns. We have stuff with Israel, Iran, Russia, Ukraine, China, Taiwan. The list goes on. They're just ramping up here. And when anything happens, it can impact the market. We saw it with Israel and Iran just over at the end of last week, going into the weekend. Investors, hedge fund managers trying to deploy or take in some cash, take some of those gains, not knowing what's going to happen over a weekend there. So there's a lot to take in there as an investor. So let's take a look at sector performance to see where have we done overall in the past month. Which sectors are performing well? We've seen a bit of a pullback in recent weeks. It hasn't lasted for entirely for a whole month, so nothing to worry about there. But let's just see where are we at overall. So in the past month, we could see top sectors have included energy, communication services, industrials, barely industrials, 0.03. If we don't include industrials, there's only two sectors that have been green over the past 30 days. And that's communication services. Think of the likes of Alphabet. Think of the likes of Meta. And then energy, something we've talked about to be bullish on for a little over a month now. Things I have are XLE. Things I have are IEO, two ETFs that I continue to put money on. Recently bought ConocoPhillips, up over 10% since buying that. The ones that have been really struggling, obviously, real estate. REITs getting hit particularly hard. REITs are very impacted by high rates. A lot of investors started to believe at the end of 2023 that, okay, with rates coming down, now's the time for REITs to perform. Well, we've got that pivot, and rates aren't, in fact, coming down. So we have to be concerned, and folks are going to say, okay, now's not the time to buy REITs. Let's sell and put our money elsewhere. Information technologies in the red over the past, down 1.5%. Materials down 2%. Consumer staples and financials down over 2.5%. Healthcare getting hit, down almost 4.5% overall. So there's a lot of sectors that have been getting hit quite hard there that we have to be mindful of when managing our own money. So rate cuts are on hold. We talked about 6 rate cuts to start the year. No way. 3 rate cuts expected as of the end of March. Now, no rate cuts are a possibility. Those are certainly on the table now. So why not? Let's do our poll again. Where do you think rate cuts will be? What number of rate cuts do you think? Do you think we will have any? Answer yes down in the comment section. Or if you are in the camp that says you're moving to the, hey, we are not having any rate cuts. Inflation isn't coming down enough. We're not seeing the type of progress that the Fed was talking about, Jerome Powell was talking about. There's no need, no reason to cut interest rates right now. Let me hear it in the comment section by answering yes, you believe there will be rate cuts, or no, you will not. You do not believe there will be any rate cuts. Maybe is not an answer there, Stephen. That's cheating. Scott's going to flip it on us too. He's going hike. And the crazy part is that is not entirely out of the question at all. So what do we got here? George is going no. Kevin is no. TJ is yes, we will get at least one. Ron's no. J-Boy's going with the maybe answer. I don't like the maybes. Christina's no. As I said, Scott's going with the hike. Delvin is yes. Jeff thinks we'll get 2. Jim Betts, good to see you, my friend. No, I think he's been in that camp. Willow is no. Okay, see, now overall, we are progressing more towards the no side of things. In the weeks past, we were not a full agreement in terms of who was saying no versus yes. There was a few outliers of saying there's no rate cuts. And most people are like, oh, we're going to get 1 or 2. Some said 3, so on and so forth. But now it's overwhelming, moving towards no. Maybe 1 later in the year. Yes, 1. 1 rate hike for Rich Diaz. So we got 2 rate hike votes so far. Sean still thinks we'll get 1. Jeffrey Hatch doesn't believe we'll get any. Sanjeet says nope. And Matthew says no way. So I'm still in the camp. I'm still holding that hope. But, it's only been 1 month of data there. So I don't want to overreact or anything like that. I'm not going to go for my 2 to 3 and say we're getting none here. But I'm leaning a lot closer to that 1 to 2 now camp, just based on the latest data overall there. So we sure were spoiled before the pandemic, off the rails. We definitely were for over a decade there in terms of where interest rates were. So, well, thank you guys for voting there. So we've talked about interest rate cuts and the Fed pivot. We've talked about fear levels. We've talked about elevated valuation. Now let's throw in earnings season is beginning. Usually, going into earnings season, you want maybe some momentum building up. Maybe we came off that low and we're starting to build some momentum. Now, we have momentum going the opposite direction right now. So can earnings save the day? we're going to see very soon. So big banks started off last Friday. We had JP Morgan, Wells Fargo starting us off. We've had some larger companies already report this week, and we have a few more to report this week. And what I've seen is you can look at the options market to kind of determine what is the expected move based on the options market. After the company reports earnings, what is the expected move for the stock, upwards or downwards? Obviously, no one knows which way a stock is going to go after earnings, but here we can look at the options market to get an idea. So with Netflix, they report tomorrow, April 18th. TSM reports tomorrow. DR Horton's going to give us an update on housing. We already talked about what the housing data was for March in particular. Let's hear what management has to say in terms of DR Horton. Does their lack of starts match with the overall housing environment as a whole? Or are they in fact speeding things up, knowing that we're in kind of this housing shortage per se? So that'll be an important one tomorrow. Genuine Parts. We have so many used cars out there. They're lasting longer, but they still need repairs. This is a company to definitely keep a close eye on that I've been watching. I don't own it, but a stock I've been watching there. And then we got an important one with American Express. So American Express, one of the 3 largest credit card holders with Visa and MasterCard. So in addition to the reporting dates that you can see on this slide, you can also see the expected move. So the move expected after hours or after they report earnings based on the options market right now. So Netflix is obviously a little bit more of a higher beta stock per se. It can move a lot more after earnings. Implied movement is going to be about 7.5%. TSM about 6%. That stock's been struggling over the past few weeks. DR Horton is right at 5%. Genuine Parts 4.5%, and then AXP at 5.2%. Do you own any of these stocks, or are you looking to own any of these stocks? Let me know down in the comment section below. So again, when it comes to earnings here, obviously it's important to see where did revenues come in compared to expectations, where did EPS come in compared to expectations. But what is the verbiage? What insights can you look into? Because these companies, especially the ones that report in the next 2 to 3 weeks, they're pretty much already going to be a month through their next quarter. So they already have 1/3 of the way of insights into the data. They can see the trends. Okay, this is trending downwards, or nope, we've kind of bottomed out. I think Q1 was the bottom out. They can get those types of insights. And I mean, they're going to choose whether they want to share those with investors or not. But that's the type of stuff you listen for on an earnings call. They usually don't type it much in a press release. And I don't listen to all the earnings call. I usually just skim through the sheets that they put out. People type up the transcript, so I can look at those and look at some of the verbiage that is used there. And it's a lot quicker for me. So if you are a hands-on investor like myself and want to do that type of stuff, that's the best way to do it right there, is look at those earnings transcripts, which you can find on the investor relations sites for the specific companies. You can find them on Seeking Alpha and things like that. So, just be mindful of that when looking at there. So let's see. Michael saw that DR Horton builds at 10%. 10% of all the new homes in the U.S. Didn't know that fact. There's a fun fact for us right there. So Kevin owns some TSM and some DR Horton, so it's a big week for him if those are large positions in the portfolio. If the rates don't go down soon, O and Vici will go down 15 to 20% from here. I mean, they're already cheap. So from that standpoint, the floor is there's not much room. I mean, you're not going to start getting into, at least I don't believe we're going to start getting to single-digit price to AFFO multiples for high-quality REITs like this. They're still collecting rent. They still have high-quality assets. It's not like they're an office REIT and things like that where they have large vacancies. We're talking about realty income. 95% plus occupancy rate. Vici, 100% occupancy rate. 100% cash collections ever since going public. That was through a pandemic when companies were closed. They own casinos. Casinos were closed. It's a testament to their operators, to the fact that the operators continue to pay their rent. There's only a few, less than a handful of REITs out there that can say they've had a 100% cash collection rate through that global pandemic. Vici is one of them. That right there speaks to the testament, the high quality of not only their buildings, but the people that they're leasing those buildings out to. Those casinos, Caesars Palace, MGM Grand, Park MGM, New York, the Mirage, Mandalay Bay. The list goes on there. So if you're a long-term investor, This again is that accumulation phase when you have the opportunity to buy stocks at a cheap price. There's never be concerned that you didn't select the exact bottom. There's a lot of people, that I've worked with that say, I feel like a stock's going to go down here. I feel like a stock's going to go up from here. We don't go based on feelings. We want to invest based on fundamentals. We want to have a reason on why we're investing. A feel is a guess. I want to look at it and say, this stock trades at a price to FFO of 11 times. It historically trades at 15 times. Nothing fundamentally has changed within the business other than the fact that interest rates are high right now. That's the only deal right now. So I have confidence investing in this company long term. Doesn't mean the stock's not going to go a little bit further down from here, but trading at 12 times, historically at 17 times, it's a pretty wide discount. Maybe it goes down to 11. Do I expect it to go down to 5? No. The companies we're talking about, Realty Income and Vici Properties, are not Medical Properties Trust. That's a company I expected to go down where it does. Very poorly run company, in my opinion, which is why I exited it years ago, thankfully. Saved myself a lot of money there. Sanjeet owns some American Express, so big week for him. So frustrating. Earnings will be positive for the most part, but the market is negatively reacting to rates. This is just hopefully something that can change the viewpoint. We're so fixated right now on interest rates as investors and sentiment right now. But if we get good earnings reports and it starts to see a trend going across the board, we could see that sentiment change. Hey, maybe it's not as bad as it was. It feels bad out there right now, but I mean, in hindsight, we are only down 5% from our highs. So let's not freak out entirely here. Valuations are starting to come back towards in line with where they historically trade. It's not like we're sitting, the stock market's down and we're still at a valuation of 23, 24 times, and S&P 500 is normally at 17 times. No, we're not at that. We're down closer to 20 times. Historically, we're at 17 and a half. So could we pull back another 5, 10%? Absolutely. 10% is technically a correction. But remember, those are healthy. Those are part of the cycle that we go through as investors. So let's take a look here at some of the facts. We had a strong Q1. What does that usually, looking at history, when we have strong first quarters to start the year, what does that look like moving forward? Well, we're on a 5-month win streak through March. Ever since we bottomed out in October, right around Halloween, stock market, it seems like, especially if you were a new investor coming in and your first day to invest was Halloween, you probably feel like the smartest person out there. I mean, you're like the Albert Einstein of investing. We surpass Warren Buffett. It's like, hey, whatever I invest in just goes up. But that's not always the case. But we are on a 5-month winning streak here in the S&P 500. Pullbacks are healthy. Remember that. Keep it in hindsight there. So strong starts to lead the year usually lead to above average results. Kind of makes sense. We've kind of given ourselves a head start here overall in terms of what we can do. But for the remainder of the year, when looking at the stats, we usually end the year pretty solid. When the stock market sees a gain in each of the first 3 months, January, February, March, which is what we've seen here to start this particular year, the final 9 months of the year have been higher 19 out of the past 20. We have grown from here 19 out of the past 20 times. So let me see if I can find this data for you guys really quick here to kind of show you. And it's a little bit blurry, so I apologize for that. It's the best image that I could find here. But this is data dating back all the way to 1950. And you could see when we had gains in January, February, and March, every single month, what happened not only in April, the following month, but also in the second quarter and also for the remainder of the year. You can see for the final 9 months, the only time that we ended down was in 1987. We ended down almost a little over 15%. Every single year from that standpoint, we are up. And we are up on an average of 9.8%, up 95% of the time. What does it look like for April? Well, there's a few in there. Nothing crazy. We have 4 down days in those 20 times, but we're higher 80% of the time in April. Q2, though, is okay. We're only higher 65%. So, we can only keep going higher because pullbacks are necessary. It resets the bull market. It doesn't take us out of a bull market. It resets things. We got to sell the winners, go find other ones that are going to be future winners for us. That's part of managing your own portfolio. So what the hedge funds are doing on a constant basis. So a lot of selling goes in maybe to the end of March there because a lot of hedge fund managers have to report what does their portfolio look like as of the end of March. So they want to position that portfolio the way they want to show it on their next report that comes out. So this is what we're looking at here. When we have January, February, March, I thought that was some unique stats there overall. Again, sorry for it being a little bit blurry there. It was the best that I could find, but thought it was still important to kind of show you guys that little tidbit there. So kind of unique fact there. All right, so we got all that. Now let's throw on top of that an election year. So we kind of already know who the two candidates are going to be. It's just going to be a replay of the last candidates that we have. So in the past 23 election years, let's take out who the candidates are. Let's just say it's a normal election year, which it'll probably be anything but. The S&P 500 usually does pretty well in election years. 19 of the past 23 elections, presidential elections, S&P 500 has posted positive results. Average return above average, 11.3%, 11.28%. And the best 3-month returns after the election day is usually when we see a split. When we see one side in the White House and a divided, or the other side holds down Congress from that standpoint. There's not a lot of hiccups that can impact the stock market from that standpoint there. So definitely something to look at there. And then to close, let's take a look, get off politics real quick. And let me take a second to talk about my free, a free newsletter and paid newsletter for Edge Plus. So we have the Stock Investor's Edge. This is my weekly newsletter. This is the way to communicate with me and to stay up with all the events that I have going on. There's a link down in the description below. If you want to sign up for the free one, you're going to get our weekly recap each and every week. What did the market do? What were some of the top news articles that went out? If you want to take things a little bit further and want to become an Edge Plus member, you're going to have access to my portfolio. You're going to have access to Chris, who's my business partner within this. He posts his portfolio, all of our buys and sells. You're going to get our monthly top 10 stocks watch list. We're going to go into one individual stock every single week, and we do a stock deep dive, going through a number of different metrics to determine, is this stock a buy, a hold? What do we rate it? In our opinion, you'll get a one brand new one every single week. And we're just about to post our latest update on Tesla. So if you're a fan of Tesla, definitely check out. We have a free trial that you can check out right now. So if you want to check it out, there's a link down in the description below. Also, if you are ready to become your own portfolio manager and you want to take things deeper, whether you've been investing for a number of years or you're brand new to investing, this is a customized coaching program where you'll be able to work with me one-on-one. Again, we're going to have a sale running if you do, in fact, join us for the webinar tomorrow. But in hindsight, you can start taking some of those spots. They're going to fill up real quick by scheduling a call. And you'll see that in the link down below with the evaluation link. You'll schedule a quick 15-minute call. We'll go through the program a little bit more in detail, what type of investor you are, what are some of your long-term goals, and you'll be able to work with me one-on-one. So that's my one-on-one coaching program there. So before we end, let's do something else here, and let's take a look at companies. You guys know I love dividend stocks. Let's look at companies that have been increasing their dividend of late. So, let's take a look here at our full page. We got Qualcomm. Qualcomm gave us a 6.25% increase. Nothing crazy there, but we'll take it. 6.25%. Anheuser-Busch with a very large dividend hike there. Johnson & Johnson, 4.2% yesterday. That was announced. What are some other? We got Aon with a 9.7% dividend hike. Constellation Brands, 13.5%. Not a big yield, but it's had some solid dividend growth there. Overall, we got Stag Industrial, monthly dividend payer. So they do their increases periodically, 0.27. So nothing to write home about at all. Another REIT right here. That's a nice little increase from a REIT, almost 6% there. There's Costco, 13.7% dividend hike. You're going to get your dividend hike. You can take your dividend, go buy yourself some gold bars over there at Costco. What else we got? We got Procter & Gamble with a nice 7%. That's from a dividend king right there. Not too often do you see a dividend king able to still increase over 5% there. So that is definitely a good thing. What else we have in April? We have Agree Realty, 1.2. Again, monthly dividends right there. That's a stock I just recently added to and looking to add a lot more there. What are some other notable companies? We got General Electric there. That's because of the spinoff there. So don't think that's, anything crazy. How about Phillips 66? Very high oil prices. These oil companies are printing free cash flow, allows them to grow that dividend by 9.5% there. TJ Maxx, almost a 13% dividend hike. What else we got in the month of April, coming to an end of April there? That is all we have. Notable companies. Obviously, there's a lot more that you can see on this list here in terms of what companies have been increasing their dividends there. So what questions do you guys have right now? But as we come up to our hour here on the Dividend Power Hour, again, thank you guys for joining me today. We had a ton that we went through overall in terms of what is going on in the market. We talked again. I hope you guys can join us for the free webinar tomorrow. If you're unable to join live, you can definitely sign up to get that recording and then reach out to me with any questions that you might have as well. We can set up, a quick 10, 15-minute call to go over any of that stuff if you are part of the VIP but aren't able to join live. So feel free to reach out there. So let's go through and see what we got. Some questions. Teresa, thank you for hitting that like button. Truly appreciate it. I'm going to scroll back up, make sure I didn't miss anything here. What do we got? What's your thoughts on AbbVie? So AbbVie, let's take a look at AbbVie real quick. See if I can pull it up really quick on let's go. I'm going to pull it up on the charts here real quick, and then we can take a look at it together. So let's take a look at AbbVie, which has been a bit of a little struggle bus right here. So let's pull AbbVie up right here. So hopefully you guys can see the chart now when it comes to AbbVie. Take that there. Question from Scott. So here's a look at the chart when it comes to AbbVie. At the top up here, you can see our RSI level overall. And then the middle is really what the chart has been doing. What has the stock been doing overall there? And it's been going down. I mean, we hit up here a level of about 183 is where we topped out. We had a double top. Couldn't get through resistance there. Couldn't get through resistance there. Usually a negative sign from a technical aspect if you are a technical trader. In addition, we saw our RSI levels that were creeping up, showing overbought territory. So it was no surprise. Did I expect this big of a pullback? No, absolutely not. I can't say that. But we also have seen a lot of bearish moves here. So with the move down, we've seen this bearish move here where we've seen lower technicals cross over other ones. We've now seen the stock blow right through its 100-day. That's what this green line is going right here. We have blown right past that. So where is the next level of support? Usually a very strong level of support is going to be that 200-day, which is about 156. Call it 156 and change because it is increasing over time. So it's probably going to be closer to 158. This leads me to believe that now looks like a decent time to nibble in some AbbVie. And I recently bought. If you are a subscriber to the Investor's Edge and you are an Edge Plus member, you're going to see that we're also going to be rolling out a Discord community where you're going to get up to the minute trade alerts anytime I buy or sell a particular stock. And one of those ones we just put in there, even though we don't have access out yet, is AbbVie. Just recently bought some AbbVie. So we're not too far away. We're at about 164 right now. 158 is the support. So maybe you get another 8 points down lower. But also, what am I looking at when I bought the other day? RSI dipping below 20. Usually an indicator right there of an oversold stock. So when I look at that RSI, when I look at the 200-day moving average, it gives me a lot more. And then you look at the other fundamentals. The PE valuation when it comes to AbbVie overall looks a lot more intriguing than it did. I actually had sold some AbbVie when we were up here, and now I just bought that back at a much lower rate there overall. So when it comes to AbbVie, if you have followed along with me, you know that that is a position I've held for quite some time. I've made a lot of money on AbbVie. It's been one of my top positions for a number of years, but the valuation just didn't make sense that I said, hey, I want to trim my position just a little bit. I'm not selling out of it completely. Let's just take some of those gains. Well, lo and behold, did I know it was going to quickly revert from 185 down to 160 in the low 160s, but sometimes you get lucky. Investing comes with luck sometimes, but we had an idea. We saw that the RSI was high. We saw valuation was high on a number of different metrics. So we put a game plan together to say, hey, let's trim here and let's buy it at a cheaper price if we get that, or a better valuation overall. And that's in fact what we saw. Stock fell 10+%, and we're getting at a much better valuation now. So long-term, love AbbVie. Hopefully that answers. That's a long-winded answer to your question there, Scott. MAA, again, when it comes to this accumulation phase I keep talking about, I keep focusing on kind of my big five positions in terms of the REITs, the two main ones being Vici Realty Income. Agree Realty is probably a third to roll in there, Simon Property Group, and things like that. So I don't have any MAA myself. I had in the past high quality apartment REIT there, but so there could be an angle overall in terms of MAA. Stonks only go up though. All right, good stuff, Mark. Thank you. I appreciate that. Thank you guys for joining me today. I'm a buyer of AbbVie here. There we go. Christina, thanks for all you do. Take care. I appreciate that. Thoughts on GILD? Haven't looked at GILD in quite some time there. What do we got? Jay Vasquez, Johnson & Johnson, Starbucks are my buys this week. Definitely looking at Starbucks. That was one of my alerts that I put out in Cashflow University with an option that I did there. So, all right. Well, if that is all the questions that we have, again, I hope you guys are able to join us tomorrow for our free webinar. I'll go back to that, throw that up on the screen so that you can see all about that. There's a link down in the description. Free webinar, an emergency update. Okay, we've got a pullback going. Fear is in the air. What do I do? How do I approach it? Well, it's really going to depend. Are we long-term investors? Are we short-term investors? How do we look at valuations? What is our overall portfolio? Are we over all of these things we're going to go through within that high-level investing, free investing webinar tomorrow. So I hope that you can join us. We have over 200 members already that'll be joining for that. So I'm truly excited there. And if you do plan to be a VIP and schedule that VIP, you will get the recording, and we'll be doing some Q&A there as well. So again, thank you guys for joining me today on the Dividend Power Hour. And again, I hope to see you tomorrow at our webinar. And with that being said, I hope you have a fantastic night, and we'll see you next week. Take care.